Hello, welcome. Today I'm joined by Harry from MFS, and I'll pass him over for a quick introduction.
Thanks, Nilesh. Yeah, my name's Harry. I am the Business Development Manager for Market Financial Solutions, MFS. We are an unregulated specialist lender in the market.
Fantastic. So unregulated, talk to me about that.
Yes.
Before you start that, so what is the difference between regulated and unregulated?
So there's unregulated and regulated brokers, lenders, products, but generally it kind of spans the whole market. So regulated effectively means that the broker, the product or the lender is regulated by the Financial Conduct Authority, and their main responsibility is really to just make sure that clients' interests are put first. So to avoid ill advice, misleading behaviour, that's kind of what the FCA is there to do.
So the regulated side, so my understanding, right, maybe people don't know this as well, is if you live in it, it becomes a regulated product, i.e. it's your primary residency, right?
From a product perspective,
From a
yes.
product, not from an advice perspective, but from a product
Correct.
side of things. So if you're going to the right broker or the right dealer, is the best way of looking at it. If you live in it, it's your primary residence, it becomes a regulated product.
Spot on.
Done. So we work very specifically in the unregulated space.
We do.
And that's where we come together at the end of the day. You know, we have clients, we have deals that come together in that space. So I really want to know is, what does the world know about unregulated?
Yep.
And what is the press behind an unregulated product?
Yeah, good question. So unregulated products, brokers, lenders in the past has had a little bit of bad press, partly because years and years ago, there's been lots of regulatory changes over the last, well, probably nearly 20 years now. And most of that is to make sure that clients' interests are protected. What really happens now is most established unregulated brokers and lenders, although they're not regulated by the FCA, they still adhere to good practice, responsible lending. It doesn't mean that just because they're not regulated, they just throw all that out the window. That isn't the case.
That misconception's gone, right? Before it used to be an unregulated product, people got really scared about it. Like if I speak to a client, say we're an unregulated broker, alarm bells start flagging because of these fly-by-night operations and the credit crunch of 2006, all that kind of jazz to go with it, right? So now we're like, yes, there's a conduct authority to go with it. So the FCA are regulating us, but not to the stage where giving different advice, because it's more B2B advice.
Yeah, much more. And part of the regulatory changes that have happened over the last few years was to make sure that a lot of lenders had an intermediary distribution arm, i.e. they worked with brokers, whether it was unreg or regulated. So I think a good way to see from a lender perspective, if they're unregulated and they're established and that they're following good practices, there's lots of kind of third-party bodies that they're members of, so like NACFB, UK Finance, BDLA, that there's lots of different, I guess, bodies that make sure their members adhere to that. So the unregulated world is way less scary than it
Definitely is, but also in the unregulated, there's a lot of compliance involved as well. There's still a lot of checks, there's a lot of training involved. We have to do it all the time, like NACFB, for example. You've got to complete regular modules on there every 3 to 6 months to make sure there's a code of conduct. There's a code of ethical lending. I think they look at it now as the best way of putting it. I think they've changed the terms of that.
And also, too right, you know, it should be. Just because a broker, like I say, or a lender is unregulated, doesn't mean they can just do what they want. It doesn't mean that anymore. No. But maybe 20 years ago, and that's the reason this regulation sort of mirroring or reflecting has come in. But yeah, we're in a good spot now.
And it's like there's a code of conduct as well, isn't there? Really, there's a duty of care, and people want to get it right the first time. I had a meeting with my compliance team a couple of weeks ago about the same thing happened there as well. It's about a duty of care and having the client come back to you, not just on the first deal, the second, the third. You know, if they're really happy with what you sold them, in terms of the package you put together, they're coming back to you again. And I also put emphasis on the lenders that we work with as well, pretty much like yourselves. You guys just don't take any case on board.
No.
You look at the merits of it. If it makes ethical sense and it's the right thing by the client, you'll give products to suit that. And what I really enjoyed when I work with MFS on this situation is that I won't just get one product.
No.
I'll have a choice of 2 or 3. Then the client makes that decision. So our job here, from your perspective and my perspective here, is just to give the client the choice. Some have a slightly higher fee, some have a slightly lower fee. One has a slightly better monthly. Some have rolled interest, some have deferred interest. There's so many variables around it. It's very difficult to pigeonhole on one solution, one package.
Correct.
Like in the regular space, in the regulated industry, you can get your standard mortgage 60 or 70% loan to value, and that would be at XYZ% and it's done. And you're price matching on rate that way. But you guys come to table with slightly quirkier, nicer deals.
Yeah, I'd agree. Maybe I'm biased, but I'd agree.
No, definitely. Like, we found that the case that we placed you, like, you know, let's go to the market overview, for example, right now. The market, where is the market today? Then I'll bring back to my point after on that one.
So the market is, there's a common misconception at the moment that and we're talking specifically at the moment about the investment market. So the regulated residential stuff we're not really touching on in this conversation, but the unregulated market, so investment properties, including bridging, buy-to-let, commercial, that kind of thing.
Semi-commercial as well?
Yeah, semi-commercial, mixed use. So that is in a better space than maybe some of the mainstream media will have you believe. So give you an example. We've got some data that we ran with, I think it was Moneyfacts, that in June this year, there was just over 4,000 buy-to-let products available, which is the most since records began. So the problem isn't that there isn't appetite and lenders don't want to lend. That's not the issue at all. What we're finding is that the market's changing where people that want to invest or stay invested are basically just becoming more professional. So those kind of casual landlords, those casual investors that maybe got into the market 15, 20 years ago to kind of their main focus was some capital gain. So for the value of the property to go up.
Yeah, or accidental landlords.
Accidental landlords,
there's a lot of them before where I think we've come across a few of those cases similar to that where they've had their main residency. They don't want to sell it. They flip it to a buy-to-let. Then they buy another one. So now they become an accidental landlord. So the property's still held in their personal name. It's not probably the most tax efficient route, but then accountants advise on that accordingly. We don't give advice on that sector, neither do you guys, right?
Absolutely
That's not our forte.
Absolutely
no,
not.
we definitely look at products and services, but that kind of thing is not our forte. But these are accidental landlords. We find that we've come across more accidental landlords than anything else. Like professional investors are out there, but they have different products, different services, and they're coming from a different point. They're more rate driven.
Yeah, and I think that doesn't mean that people aren't getting into the market and becoming kind of first-time investors or first-time landlords. That's not the case. But what it does mean is that, like I was saying, people used to be able to get away with the rental yield was secondary, and they kind of, now that that's become more difficult to obtain, they've kind of sold on, and that's where you'll see the mainstream media saying that the buy-to-let market's sort of evaporating. The people that are buying these properties are just more professional. Whether that's their first investment or 101st, they just are treating it like a business.
They're running, if you look at London property, like London's a different beast. Like if you look at anything within the M25, it's a different kettle of fish.
Yes.
It's an economy within an economy, right?
Yep.
I find that the clients that we speak to, and probably you've made from your perspective as well, that properties within London, it's not about yield. They're more capital growth.
Yeah, because the yield, let's be honest, is compared to the rest of the country, it's not great.
No, it's 100% not. But then you can go up north, for example, say outside the M25, Leeds. I think Leeds is quite big right now. Nottingham's quite big as well.
Yeah.
There's a few investment companies.
Northeast.
Northeast, yeah, definitely. But there's a lot of investment going on there as well. Don't take me wrong. They're really chucking some big money out there.
Yeah.
Those yields there are 7 or 8%, sometimes double digits. But the capital growth is so small. So what's more beneficial for that? There's two parts of the portfolio, isn't there?
Correct.
So if you're a professional investor, you're looking at two things. Do you want cash flow or do you want capital growth? And London, but then look at the price of a property in London. I think I read a stat the other day. I think minimum price was like 390 or something. It's trivial.
I can well imagine. Yeah, I mean, so some of the caseloads we deal with, I mean, we very rarely, and I just for context, I look after kind of the southeast, but like part of South London as well, and we very, very rarely see a property below that. Very rarely.
And these are like your one-bedroom shoebox flats. 350, 400 square foot type thing. It's just unbelievable. Then you put that in a context, you can go different part of the UK and have a 2 up, 2 down.
Oh, and some.
Yeah. Right now, it costs you less than 100 grand.
Yep.
And those things will yield you, I think, a 2 up, 2 down in Manchester. I did a deal for a client recently, just outside Manchester. 2 up, 2 down was like 75 grand. And that rents for 700 grand a month. So the yields there are phenomenal. But the problem there is you'll never be able to sell that property because it's a renter's market. Yeah,
you're not going to have huge capital appreciation. But that's where it comes down to brokers doing what they do best, is finding out for the client, what do you want from this investment? What's important? What's less important? Everything's important, but what's less important? What's your focus? And you can go from there.
Definitely, that's where the questions come into play, right? So before we put a case over to you guys, there's a lot of due diligence going in the background for us. We have to go through the fact find. We have to make sure that the client is in a position to invest. Done the right questions are asked. And that way, when it comes over to you guys, your underwriters get involved. And what I find is that the underwriter really pushes back on certain things. They're quite difficult, not difficult to deal with, but they ask the right questions.
Yeah, it's their job, right? So it's a good point. We, as a lender, so the way we work at Market Financial Solutions, but the industry is roughly the same, is that my job is to speak to brokers to understand how to structure the deal, what the client's looking to obtain, what the strengths of the deal are, what the weaknesses of the deal are. We together, so you and I, will then present that to underwriting and say, look, here's a case that we're looking at for Nilesh. The end client is Mr. Client. Here's the strengths of the deal. Here's the bits that we're going to mitigate. Here's where we think we can get over these. What do we think? And that point is where the underwriter comes in and says,
there you go. But at that point, it also brings another crucial point we spoke about the other day. There's transparency,
yep,
then there's complexity.
Correct.
And a lot of people don't understand the difference between the two. You know, so this is where I like to get some feedback from yourself. You can have a complex case, but if we don't know the intricacies behind that complex case and why certain things have happened, why X, Y, Z happened in their profile, it makes the case very not valid. The complexity is out the window, then it becomes very messy and sticky to work with.
Yes. So I work with brokers, like I say, all over the Southeast with all types of different cases. And ultimately, lenders now, unregulated or regulated, will find out what's going on with the case. The option for the client is either you tell them at outset and we will hopefully find a way to work with it, or you find out maybe at val, maybe at underwriting, maybe at solicitor's due diligence, maybe the day before completion. And the issue you have with that is you're probably well in with cost, time, maybe stress if it's a really complicated deal that has some urgency. So the more transparent you can be with your broker, the broker will then relay that to the lender, and then we can iron out those issues straight away.
Definitely. I tell my clients there's two people you can trust. Broker's one of them, and your solicitor.
Yeah.
Have complete transparency, and they'll support you the best way possible. If it's good, bad, or indifferent, there are, like you've probably seen, it's been in the market for so long, there are specific lenders for each profile.
Yeah, of course there is. Yeah,
you can have a squeaky clean client who's got perfect credit, they'll go to the high street lenders for that one. But then certain businesses, or certain lenders, should I say, have a certain demographic they work with, or placement. Now, for you guys, there's a certain placement you work with, and that's your strong point.
Yeah, every lender has their niche. A lot are volume-driven, rate-driven, and they want clean-cut business. A lot will focus on certain nationalities. A lot will focus on adverse credit, complex structures, whatever their niche is. But I'd like to think now there's so many lenders in the market, there is an answer out there for everyone.
Yeah.
Give or take. You just got to find it.
100%, but that only works by having the right broker.
Correct.
And this is where the value of the broker comes into play. And a lot of people do not understand that. Some ones that do understand it, they're gospel to their brokers.
Yep.
And this is where you find by working with people like ourselves, that once they understand that concept, the broker market becomes phenomenal to them.
Correct. I've worked with intermediaries for, 10 years maybe, something like that. It must be about a decade. Intermediaries have always been important, but they are more important than ever because nothing is straightforward.
No.
And it's also access. If I'm an end client and I'm very familiar with the market, and maybe that's my kind of, I work in financial services or I work in lending, you still won't have access to all of those 4,000 purely just buy to let, then you throw in bridging, then you throw in everything else. Those thousands of products that you guys do, and most brokers do. So not only is it access, it's assistance, it's support. I've said it for years, but a good broker's worth their weight in gold.
Definitely, it's how they put the case together.
Yeah.
So if the broker gets all the information, when I present the case to you, we've ironed out certain things that need to be ironed out, or certain things that don't need to be disclosed, don't need to be disclosed. But if there's a duty of care at your end, if a client sends you something, there's a duty of care to look at it. Like if you don't ask for 6 months bank statements, you ask for 3. If I send you 6 and something happened in month 5,
guess what?
You're looking at it.
Yeah.
There's a duty of care to look at that information.
Correct.
So then if you don't, some people think that giving more is better. Sometimes giving you exactly what you need is the right thing to do.
Yes, when we look at deals, which again, all of the business I do personally comes through an intermediary, but as a business, nearly probably 99% comes through an intermediary. So when the broker submits what we're asking for, you're right, I've seen it over the years where clients provide everything they can to kind of, and the intent is to strengthen the case. Sometimes it causes more questions than answers.
Yeah, there's something in the background that just...
Providing it to your broker is one thing. So saying, look, here's everything, and you can say, look, thanks for that, but I don't need this, or I don't need that. But yeah, when you then package it with us, it's really important to just
clean up.
Give us what we need.
There's one question I really want to raise with you, which will discuss the marketplace. Bridging.
Yes.
Why do people need bridging, and what's the purpose of bridging?
Yeah. Just that?
Just that?
Yeah, okay. So bridging finance, for anyone that's listening that maybe doesn't know, is ultimately a short-term financial solution to bridge a gap. The most common idea of bridging that probably people outside of the industry have is for like chain breaks. So they're buying their residential, something happens with the sale, they really fell in love with the property, and they just need to get a bridge to buy it until their residential sells. And that's still a really common reason for kind of regulated bridging. But ultimately, the main, again, we looked at some data, I think from April this year, the main use for bridging is still refurb. So to do work. So bridging loans can be used to either acquire a property and then allow you to do the works. Some bridging lenders will provide the funding for that cost of works. So ultimately, bridging finance is used to acquire an asset, raise some money, do some refurb, but the idea of it is short, quick and easy.
So for example, if I'm buying a property at auction, for example, right now, we're buying it slightly cheaper than the market dictates.
Yep.
So we can buy it from auction, complete very quickly because the bridge product completes a lot quicker, right?
Correct.
Average turnaround time, less than 28 days.
Yeah, I mean, with auction finance, it has to be. So, as we do auction bridges, so you don't, yes, there's some leniency a few days either side, but you've got to complete within 28 days. So
definitely.
You need
if you're a novice investor going to market, trying to read all this press back, trying to get these things sorted out. So you go to market, you find a property auction, you put your 10% deposit down, whichever the auction dictates anyway. You complete on a bridge, you renovate slightly, or mild, heavy, whatever required on there.
Yep.
Then we can move to a term product.
Yes.
Which is a secured 5-year, 10-year product in the sense that there's security behind the asset. The rates are slightly lower, so people understand who are watching right now. It's a long-term solution. So obviously, the longer term you borrow it, the cheaper it becomes.
Spot on.
Bridging is expensive in the beginning because you're paying a higher rate because the turnaround time is a lot quicker.
Yeah. So what is the question? What's the difference between term? Is it, or you just
just a general overview on that front?
So bridging can be expensive. It's normally most expensive if you don't stick to your original agreed term, whether it's 6 months, 12 months, 18 months. It's when you go over that when it starts to become really expensive. But ultimately, bridging finance is a monthly cost at a set percentage for a set term, and it's short term.
It's a short-term loan.
Correct.
It's a bit like a giant credit card for your house, isn't it, really?
A little bit, yeah. It's probably not a bad way to look at it. It's effectively a means to an end to achieve, like I say, an acquisition of a property, refurb, whatever. If we're talking about bridge exiting, so how you kind of come out of that bridge, which is really important. So for anyone listening that's looking at bridging finance, and your broker will speak to you about this, but the main thing lenders look at is exit. And what that really means is, how are we going to get our money back at the end of that agreed term?
What's the strategy behind it?
What's the strategy? Definitely. Now, the two key ones are sale of property. So I'm going to flip the property effectively. I'm going to buy it at auction, do some refurb, add some value, sell it, there's your money back. The other more common reason is refinance, and that's what you're talking about going on to term. So for us, so we offer both of those products, but in the market, you have the usual kind of exit for bridging on refinance is a buy-to-let loan. So your intention is to keep the asset or keep the property, let it out to a tenant or tenants, and that term loan takes out the bridge. So that exits the bridge. So
that way the lender's paid back.
Correct.
The lender's got their security or their investment back again. And now you're on a term product, which is a 2 or a 3 year product, which you can refi over and over again like a normal household mortgage.
Like a residential.
Like a residential, exactly. They've got the rent coming through, it's servicing the debt. So now that asset can be parked to one side and move on to the next deal.
Spot on.
That also brings me, before we wrap up today, I've got one question to raise with you. Bridge exits sometimes don't always go to plan. So sometimes there's defaults, something goes wrong. So how do your business deal with it, and what can people do to avoid getting in that situation?
It's a good question. It's really important. So with bridge exiting and defaulting on bridging loans and things like that, and whatever you want to call it, ultimately, the best thing a client can do is tell your broker, if you're using one, and or the lender, where you're at. So a lot of this is done post-completion. So what we mean by that is Market Financial Solutions will lend you the money, we complete, there's your day one advance, there's your money. You've got a refurb project, maybe you're flipping it and selling it, maybe you're retaining it, whatever you're doing. You're normally doing a lot of work or a lot of process post-completion. Therefore, we lose sight of it a little bit as a lender because we're not doing any transactions with you. So the most important thing is to keep the lender updated. If let's say you've got a 12-month bridge and the intention was to do some medium refurb and then sell it at the end of that 12 months. Let's say we're on month 10 and you're thinking,
need a couple of days.
I'm not gonna make this deadline. I won't speak for every lender, but at Market Financial Solutions, if you give us a call and you give us the heads up and you explain what you're looking to do, we've got a dedicated servicing team, and their sole job is to work
They're very, very good, actually.
Yeah, their sole job is to work with clients to make sure that we're working with you. We're not interested in just saying, right, if you're a day over, here's whack on a load of interest, or
or take the property back. You guys are not in the marketplace of taking on, like, you like debt, don't take me wrong, but you don't want to be in a position where you're buying portfolios that have gone wrong.
No,
like that's not
good business.
That's not good business. And then ultimately you get a bad rep in the process to go with it. So you guys are in the process of supporting the client.
Correct. And that's a big thing for us.
Definitely. So we can wrap it up from there. Thank you so much today. I really appreciate the time.
You're welcome.
Pleasure.
Thanks, Nilesh. Thanks for having me on.
Appreciate it.